United Healthcare stock has risen about 17% in the past 6 months. Today we'll be looking at a clear market leader with a wide moat, and we'll also be analyzing why the TipRank Smart Score gives it a 10 out of 10 for an outperform for the stock. It has strong buy from analyst consensus, bullish sentiment for the news, and increased hedge fund tendencies. So we'll be looking at United Healthcare. In their annual report, they say that they are a healthcare and well-being company with a mission to help people live healthier lives. They have two different types of offerings. The first one, it's called Optum, and it is an information and technology health services business which serves the broad healthcare marketplace. They divide Optum into three different categories. The first one is health, where it helps different hospitals and different doctors provide better care for their patients. Then they have the data segment, which improves the way that hospitals can actually manage the data for their different patients and optimize the way they use this information. And finally, they have the Optum Pharmacy segment, which, as the name states, runs pharmacies and different pharmaceutical products to deliver to the patients from the hospitals. Then they have the United Healthcare, which offers a full range of health benefits, and it enables affordable coverage and access to high quality care for their different clients. In terms of competition in this segment, they say that it hugely depends on the quality and the value provided to the customers, and that if the quality and the value is not at standard, there is a lot of rotation between customers. That is why UNH always provides the best possible value to their clients. One thing I didn't like about their annual report is that they didn't mention anything about their future growth strategy. But that is okay because fundamentally this is a very sound company. As we can see for their financial analysis, they have an okay return on capital employed sitting at 11%. I would like to see this a lot higher. However, since it's such a big company in an industry where your margins cannot be really high, I understand that this is a good one amongst their peers. They have a very good interest cover of 14 times, meaning that there is low liability risk and a solid cash conversion of 92%. Their margins, 25% for profit margin and a low 9% for operating margin since it's a healthcare industry. Further analyzing their financials, we can see that their revenue, their gross profit, and their net income have been increasing quarter after quarter. As you can see, their margins have been extremely consistent as well. In terms of their efficiency ratios, these have also been very consistent with an incredible return on invested capital of 40% right now. When looking at their fundamental analysis, this company gets a solid 7 out of 8. They have very low liability risk with a 14 times interest coverage ratio, which is pretty solid for a company its size. They have an extremely solid balance sheet, and they are very consistent with their cash flows. And of course they're consistent because in my case, whenever I have worked with a medical company, if the service has been of standard or at least I have been happy with it, I will never change the company because it's easier to just stay with the one you have. And if you don't find a competitor with hugely different prices, you will stick to the same one you have. In terms of dividends and share buybacks, they have a very solid dividend which has grown quarter over quarter, and I will show you in the next slide. They have very good organic revenue growth and an existing moat/competitive advantage. Why? Well, because they have already an established brand and huge customer loyalty from their current client bases. And this allows them not only to have a competitive advantage over their competitors, but also to obtain pricing power, which is what we want to see in the companies that we invest in. In terms of organic free cash flow growth, I have not seen this because in 2023, every quarter has been decreasing. So this worries me a bit about the company, and I would like to see in their future filings what their plans are to fix this. But here is the dividend. As you can see, it has been growing every single quarter in terms of the dividend per share and in terms of the amount paid as well. You can see that the dividend has been fairly stable, sitting at around 1.5% for the past 4 years, and now it's sitting just a bit underneath the average, but I wouldn't say it's at a huge discount. Moving on to their long-term analysis, I believe this company follows some secular trends, as especially with their Optum service, they're providing data management to hospitals, which follows the secular trend of big data management and all the trends about analytics, because now more than ever, data is power. In terms of their growth potential, I think they have two growth avenues which they could follow. The first one is improving their existing customers, not only their experience, but also the revenue they get per customer. And the second one is in terms of attracting newer clients and also developing newer offerings. I think this company is at the point where attracting newer clients is very difficult because it already has such a huge client basis. So what they would have to do is either improve their current offerings and charge a higher price for them, or develop newer offerings. However, I am unsure about this since in their annual report, they did not state anything about their future strategy. In terms of a historic PE ratio, I would say this company is trading at around average or a bit higher than average. As you can see, the lowest points were right when the pandemic hit in 2020, and since then the stock rose, but right now it's not at the highest it has been. And as you can see from the EPS, it's growing consistently, which is good to see in a company of this size. Using its 2022 free cash flow, we get a yield of 4.71%, which means that the company is attractively priced against the 3% long-term inflation rate. However, as we spoke about it before, in 2023 the free cash flows have actually gone down, so I would not think that this company is attractively priced right now. Moving on to the risks and possible challenges, I don't see this company having too many risks in the short-term future. In terms of competitors, yes, it is a very competitive segment. However, I believe that since this company is so big, has such established brand and such a wide customer base, it already has such a big competitive advantage over its competitors that this won't be considered a challenge for them. In terms of regulation, I don't see any changes coming up in the short term regarding the US healthcare segment. And in terms of performance, it is the one that worries me the most, so I'll talk about the market first. I don't think there is a risk for an economic downturn, and even if there was, I think healthcare is one of those sectors where even if there is an economic downturn, there will be no shortage of sales, and people would pay millions to be healthy even if the economy is going very badly. And now in terms of performance, which is the biggest risk in my opinion, I would like to wait until the 2023 end of year annual report because I would like to have an explanation on, first of all, why the free cash flow has actually been decreasing throughout the year, and second-wise, what their plans are to try and actually improve these free cash flows. Before moving on to the investment conclusion, please remember that I'm not a financial advisor and this is not financial advice, so please do your own due diligence before investing in the company. But I believe that UNH has a moat and a strong competitive advantage, followed by consistent cash flows which are predictable and resilient. I would just want to wait and see what they say about their 2023 cash flows going down. And then they also have a high return on capital employed, which manages to create value for the investor. So overall, I believe that this is a good company and it could be a good investment with possible high returns. Thank you for watching. As always, this has been the Cash Flow Compounder. There is a link in bio for a free stock if you join Trade Republic or Trading 212, and you can join the free Patreon for extra content and alerts for my buys and sells.